Good morning and welcome to the Amer Sports 2017 Capital Markets Day. My name is Heikki Takala. I'm the CEO of the company since 2010. I'm proud to be the CEO of a company which is performing well, which has a proven track record of performance. We have a whole host of globally leading consumer-loved brands, and we have the ability and capability to stay ahead of the trends, to transform ourselves when the market is changing or when we see the consumer changing. We want to win with the consumer today and tomorrow. And that's what today's event is all about. We talk about sustainable, profitable growth whilst accelerating our transformation. The topics of the day, we talk about the company logic as always, and we show that the drivers, our strategic drivers, are largely unchanged and our growth continues. Building blocks going forward are robust and they drive the consumer-led transformation to win in the marketplace today and tomorrow. The external context is challenging and it calls for adjustments to some of our targets. We will prioritize profitable growth. We choose not to overinvest into growth. We prioritize profitable growth. This new model, the reprioritized growth, does create value and continues to build financial strength for the company. So let's go through them one by one. First, starting from our sustainable growth model, our portfolio logic, and current performance. So almost a reminder, our sustainable growth model consists of 4 components. First, annual top-line growth. It's annual. Secondly, annual profit and cash flow improvement. Again, annual. And every year investing for the future, not maximizing the short-term results, but making sure that we do well over the cycle. Finally, continuous renewal and productivity improvement to make the company better every day. A few comments on all of these. First, on the annual top-line growth. The growth can come from organic growth or it can come from acquisitions. We prefer organic growth. We believe we have so much potential still in the portfolio. However, as you've seen over the past couple of years, acquisitions are also in the toolbox. Annual profit improvement. Profit can come from growth, gross margin, or cost control. We use all 3. All 3 are firmly in our toolbox. And investing for the future, we make sure that we win over the cycle. We don't seek to win in any given year if that would then jeopardize the future. So we make sure it's a balanced model. We create value in our business units, and then we create value through corporate company scale and synergy. So in 2 areas. Every of our business units or our brands, they have a clear role, whether that is growth, whether that is profitability, or cash generation, and they work against that role based on the market dynamic and the brand potential. Then we drive scale and synergy. In areas where the brands would not do better on a standalone basis, we scale things up. And typically, this happens in go-to-market. So I take an example. Our country operation supports all of the brands. Our e-commerce supports all of the brands. Our own retail model supports all of the brands. Our strategic customer management, our commercial strategy supports all of the brands. If I take a practical example, for example, China, none of our brands could have entered successfully on a standalone basis the way we've been able to do it through the portfolio. So today in Amer Sports China, we already have a 400 and 450 person organization. We have grown it from 0 to soon 150 million, and we'll fly by 200 million, and we are able to support the total portfolio. Secondly, operations. Clearly, we have scaled up our global distribution, our warehousing, our transportation, and operations is giving the same support to all of the brands in the company. Third one, digital platform. We have invested into one digital platform which is able to scale itself to support each and every one of the brands, be it our e-commerce systems, be it our digital marketing, be it our database, where we basically use an Amer Sports database rather than doing it brand by brand. It's giving significant scale impacts. And finally, of course, the company gives the long-term investment capacity through strong balance sheet. So we can either invest into a business, invest into it upfront, turn it around, or overinvest for it to reach its future potential, depending on the role each and every of the brands or business units play in the portfolio. Our long-term portfolio aspirational logic is unchanged. So we have our three legs. That's the grand outdoor, that is the ball sports leg, and then it's our fitness leg. If we take them one by one, we want to be the global leader in the grand outdoor sports. Here we have various brands and categories in that leg, and they play different roles. Clearly, Salomon and Arc'teryx, our soft goods brands, they are there to drive profitable growth and to sweeten the mix. We have our winter sport equipment, where we know that the winters can be good or bad. We're not seeking for growth, we're rather seeking to drive profitability and cash generation, irrespective of the weather conditions. We have Suunto, our sports instruments, playing in a category which is growing fast, and clearly there we're looking for growth. And then finally, we got our cycling business, which is fundamentally strong, but the industry is going through a bit of a blip. And at this moment, we're looking still at it as a future growth driver. So this category clearly, or this leg in the company, is there to drive growth and drive profitable growth. The situation is quite different in ball sports. That business is fundamentally not growing because participation is not growing, and basically the US situation, the wholesale situation, is impacting especially team sports quite a lot. So we're not fundamentally seeking to grow the business, we're rather going for cash and profit. We still want to grow, but we don't overly push for growth. Cash and profit is the name of the game. And then the third one is fitness. We seek to be on the global podium in the commercial fitness, and clearly we see that the underlying dynamics in that industry are very positive. The growth trend continues. The consumers are getting into fitness, into health in the new countries such as China, Far East, and so, and we see strong future growth potential. Hence, we have invested into this business to grow in the future. And the expectation, of course, is that that growth continues to be profitable. Short-term view, so instead of talking performance in detail, we confirm our 2017 view. The full year net sales are, in local currencies are expected to grow from last year, and EBIT, excluding IAC, expected to be at approximately last year's level. And the growth is expected to be biased to the second half of the year. It's not going to be a skyrocketing growth. It's coming gradually, but we see things starting to improve. Now, the ones who want to always look at how the growth comes between the quarters, I would say look at the whole H2, because it's always with the winter sport equipment shipments and all of that, where it either happens in the end of September or early October. So the quarterly split is less important. It's more the H2 overall. Then looking a bit at the longer term, so we now have 7 years of profitable growth in our pocket, and we've gone through a lot of peaks and valleys, but we have an unbroken record of growth and improvement. And not every year has been stable, especially on the EBIT line. That's okay, that happens to the businesses, and we've been able to fly by a lot of turbulences in the marketplace. Early on, be it the difficult winters, be it the Russian situation, or be it Latin America crisis, and so on. And still we are there, driven by a lot of transformation, new building blocks, and things which pave the company well for the long term. Strategic priorities, where do we stand there, and what are the implications? So If we start from the underlying consumer trends and their impact on Amer Sports, first of all, as always, fitness, health, and well-being are there to stay. They are fashionable, they are part of consumers' lives. In more and more countries, the young generations are health, fitness conscious. Outdoor and sports are blending, activity and lifestyle are coming together, there's a mixing of motivations, and that's giving us a lot of opportunities. We see more and more consumers wearing outdoor product in the city environment, and that of course is a great opportunity for us. Urbanization, megacities, emerging markets, more and more consumers globally are coming to our segments. More and more consumers are living in the cities. They do their activities in the cities, but they want to live an active outdoor life, and of course the trend is there positive. Sustainability, quality. Consumers are going for sustainability, quality, better quality. We play in the premium segments, in the higher quality segments. Once we get consumers to come into our categories, they later on trade up and trade across to our brands because we stand for longevity, we stand for quality, we stand for sustainability. Great product which lasts forever. However, as always, there are challenges in the marketplace, and that's driven by the fast-changing consumer. The US wholesale slowed down in H2 in 2016, actually mostly in Q4 last year, and that happened mostly in the brick-and-mortar sector, whilst the e-tail and brand direct-to-consumer continued to do well and still continues to do well. Consumers are clearly changing. They're changing their shopping habits and their shopping practices, and we've seen that they move into more direct engagement and personalization. They want to engage directly with the brands. What does it mean? It means that the brands need to do more themselves. In the good old days, we could get distribution in the big boxes and just expand distribution, and that was the growth model. Today, we need to do much more ourselves. That makes the growth also more expensive because we need to push into the space we didn't play in the past. But that's also more attractive because we are able to create that connection with the consumer, that lifetime connection, which then lasts and which leads to loyalty and hopefully more profitable sales in the long term. The slowdown had an impact on us. So confidently planning last year at this event for the future, then we saw something else happening. And basically, since the Q4 16, we've seen that the US wholesale, against everybody's expectation, has not rebounded. And this has led to a gap versus our 2020 glide path. And this gap has now been worked on by many companies since Q4 last year. And as we look at it, we see clearly that the majority of our acceleration areas, which were the basis for our glide path, they continue to work. So one by one, apparel and footwear, we had a strong CAGR target, B2C the same, China the same, and connected devices and services. All of these are working, but the US market situation is clearly a red flag. And whilst we were looking for a 9% year-on-year growth in the United States, reality looks like low single-digit growth at this moment. Hence, that is a gap which is difficult or expensive to close. If you look at the areas which we marked as light green or a bit yellowish, it's because some of the impact, or it's because of the US slowdown also slightly impacts the apparel and footwear and the connected devices and services business, but nothing major there. We're really looking at the US as a standalone here. So what do? We see that the majority of the things are working, and the United States is still super important for us as the largest sporting goods market in the world. So we keep our strategic choices and priorities unchanged, but we choose to adjust our targets for sustainable, profitable growth. It doesn't make sense to go and close the gap at all cost. Demand for our brands continues to be strong. We see it every day. The consumers prefer our brands. Our market shares are up. We are outperforming the market in most of our segments, but the gap is still there. And as growth is becoming more expensive, we now prioritize profitability to drive better value and better returns. So we've chosen to adjust the growth target, and we now target mid-single-digit annual growth, and we prioritize profitability, which is going to get a significantly bigger weight in our glide path going forward. But again, the strategic priorities are unchanged. We know that we will do well in China. We will do well in soft goods. We need to do well in business to consumer because of the change and the connected devices. The whole digitalization is a trend to stay, and we are well positioned to play there. And also in the United States, we have relative strength, but we cannot compensate for the absolute weakness which is there in the marketplace at this moment. Whilst we adjust the targets, our building blocks are strong, and we are very confident going forward. So our glide path looks good, and it's well supported by sufficiency of exciting things. And I just give a couple of examples so that you can see what the company is working on. So clearly, we drive in soft goods, business to consumer, and China. We continue that 25 new store opening every year. You see the stores being opened mostly in China because the demand is there. That is also supporting our soft goods, so Arc'teryx and Salomon. And if I look at their pipeline is strong. We look at our next seasons, we look at our spring, summer 18, fall, winter 18, the reaction to our collections is very strong. So things are good here, and we seek to go fast. We are accelerating our go-to-market transformation. Over the past 12 months, we have totally reorganized our go-to-market model in the company, and we are today well equipped to win in the changing world. So over the past years, as you know, we built already e-commerce, we built e-tail, we built own retail, so everything which is needed to run a modern go-to-market. But over the past 12 months, we actually changed hundreds and hundreds and hundreds of people to new positions to make sure that we stay ahead of the game. And here are just a couple of examples how we look in e-tail online today. We play in places like Japan, in China, and we play with the biggest online retailers in the world, and we have successful joint business plans with them, and we are able to create a real commercial progress in those areas. At the same time, we still have untapped potential in our own portfolio. So on the right side, you see an example from Wilson Tennis. Wilson Tennis has just gone online in the United States. We qualified a commercial model, which is a winning model, and it's enabled by the company's ability to do customization. So we go much deeper in our consumer relationship than just selling. It's not only a grocery store, it's much more. And that's giving us millions of people who want to come, engage, and maybe buy now or buy later on. But we're talking all the time about deeper consumer engagement, not only the shopping transaction. We like the shopping transaction, that's what's giving us the revenue, but we need to get people to like it and keep coming back to us. Then just the core product pipeline. It's always strong. So we have Arc'teryx full of exciting news. Salomon the same. Here is an example of a Salomon customized shoe. You can customize your shoe today in places like France. And so our new tennis look and feel, our new design, which has given us, if not 10 share points, not far away from that in the biggest markets in the performance tennis segment, really resonating well with the consumer. We have an example of our new Atomic lineup. It's given us the highest ever confidence on our pre-orders. We're doing really well on Atomic this year. The product is strong, the design is beautiful, and again, the core product continues to do well. On the right side, you see a couple of examples of us taking our hard goods leadership in Mavic and pushing into into areas in soft goods, but not only to make product, but make the product look beautiful, desirable, and much more engaging than just a technical product. Keeping going, scale and synergy, they enable new profitable business. So I have a couple of examples here. I take them one by one. On the left side, there's our megacity focus. So we go to the biggest cities in the world as a company. So we have a megacity program in place for New York, for Shanghai, for Beijing, for London, which is the picture here, for Paris, and so. And that's enabling the full portfolio to do better rather than the brands going one by one. The next one is a jersey, cycling jersey from Envy. We acquired Envy just about a year ago, and now we are able to take that hot brand and start to expand it into soft goods, of course, enabled by the company's soft goods capabilities. Below that, you see an Arc'teryx shoe, enabled by our knowledge of the footwear category in the broader company. On the right side, the latest acquisition, that's Armada. It's a bolt-on. We can just directly start to produce it and gain a lot of scale and synergy benefits because we're just integrating it into our existing system. And then in the middle, you see the new Suunto lineup. There are 3 different variants, and basically Suunto now has in place a scalable, synergistic software platform on which we can build the future pipeline. We don't need to touch it anymore. So over the past year, we made significant investment there, but now we can scale it. There are new variants, new families, new things coming, utilizing exactly the same platform, scalable, synergistic, expected to give us really profitable growth. And finally, exactly the same on fitness. There is a Precor console. It's scalable, it's ready. We have about 60,000 of these installed globally, and we can basically update them all, upgrade them all by just pushing one button, and we can provide new content year in, or day in, day out, year in, year out. A lot of good things happening, and we are confident. We're dealing with the turbulence. We'll get over it. And of course, everything we do here, the examples, are the building blocks, how we dealing with the situation and winning with the consumer today and tomorrow. So this is my part, and I conclude here, and then I hand over to Jussi Siitonen, our CFO, for a deeper dive into the financials and the value creation model. So Jussi, please.
Thank you, Heikki, and good morning, everyone. So in the approximately next 20 minutes, we'll dive into financials of our strategy for prioritized profitability. We go through our guided P&L structure for the future. We go through the building blocks behind, and then the drivers for our cash flow and sustainable balance sheet. For each of the main building blocks and KPIs, I'll provide you with the last 3-year performance, and then also our 2020 targets. So 3 years of history, 3 years of future. On top of that, I'll give you an update on our M&A. Let's start first with our financial targets. As you can see, the only change is made on our growth target, which now better reflects the prioritized profitability over overly expensive top-line growth. In other words, we see, especially in the current context, that holding on the old growth target, it would not only be uncertain, but surely too expensive. On profitability, target remain unchanged, but the point is here in the brackets. It's now prioritized. When it comes to cash flow conversion and net debt EBITDA, the targets remain unchanged. Our directional P&L structure target for 2020, based on the building blocks what we have, both for gross margin and OpEx efficiency. These building blocks are expected to take us to the gross margin level of 46-47, and on OpEx level to 36-37%. On gross margin, you can see that we have been already on that level quite recently, i.e. in 2016. However, that was very much FX driven and therefore cannot be considered being sustainable. Whilst we are not giving any explicit EBIT margin target, you can see the components here and you can figure out the directional range of the targeted profitability. More importantly, I will open up the building blocks and KPIs what we have for both gross margin and OpEx to help you understand how we are driving them towards the target. Let's start first with the gross margin. Here on the left, you can see our 3-year annualized gross margin improvement until end of Q2 this year. This improvement of 160 basis points is coming in quite evenly from 4 different main drivers. And 3 out of these 4 drivers, better channel mix, i.e. more B2C, sweetening brand mix, having higher growth in Arc'teryx, Salomon soft goods, but also now in future in Suunto. They are driving up our gross margin. And then continuous operations improvement when it comes to automation of the production, lead times, etc. So these 3 building blocks are the ones in which we believe we have solid track record of driving up our gross margin to the level of 46, 47. The fourth one, FX, especially with the current visibility, is expected to partly offset this improvement. But overall, we believe that we have solid track record to make this 46, 47% level. On OpEx side, following the years of significant acceleration investment, we are now returning gradually back to the normalized OpEx spend. Before going more into details, let me explain these OpEx categories what we have. We have top-line driven OpEx category, including sales and distribution cost, sell-in and sell-through marketing, warehousing cost, and the likes. We have investment-driven OpEx, where we have R&D and new retail openings. And then we have maintenance, which is practically all G&A. On top-line driven OpEx growth, you can see that more we have B2C in our portfolio, more expensive is the growth. For example, during the last 12 months, when the growth is 1.1%, it's still quite a significant OpEx growth what we have on top-line driven OpEx. However, we need to also remember that this B2C is coming in with much better gross margin, and therefore, the whole P&L logic is still very solid. On investment-driven OpEx, you can see that it has been the biggest part of our OpEx growth recently. One thing should be noted here is that approximately 1/3 of this growth is non-cash, i.e. coming from amortization of those development Capex what we have in 2015, 2016. I'm getting back to Capex later, but we are amortizing these development Capex in 3 years' time. And then the maintenance Capex reflects successful restructuring, what we have had recently. All these savings we have invested back into acceleration. The way we allocate OpEx to the businesses remains the same. The businesses where the potential is highest, like Arc'teryx, like Salomon soft goods. We have invested back to businesses all the way up to full top-line growth. However, now for the future, also in these businesses, we are looking for improving OpEx leverage. Then the businesses where growth is low or uncertain, or the functions, we are at low or even zero OpEx level growth. So how then to push down the OpEx to the level of 36, 37, which is pretty much 200 basis points versus the baseline of 2016. We have 3 key levers to pull. The first one is right-size acceleration investment, especially in digital and USA. Digital, because those main platform investments are gradually getting to their end. And then USA, as Heikki already mentioned, we see lower growth potential at the very moment. We are further leveraging our OpEx through fluidity, so that's the normal business we do every time. And on top of these, we continue further restructuring for faster productivity improvement, as we have earlier announced. On the last topic here, the restructuring we announced exactly a year ago in this very same event. We have now successfully completed that part, so that the plan was to get it completed by end of 2017. So we are now some 6 months ahead of the plans. We have achieved a full run rate savings of 50 million euros, which is then invested back into businesses, as I mentioned. The last tails of these programs are now part of the expansions we announced in February. And let me remind you on this February restructuring. So it's not yet another restructuring, it's just expansion of the ongoing one. Target there is not now to invest back in acceleration, but really looking for OpEx cuts worth of roughly 100 basis points on EBIT margin by end of in the next 24 months, baseline being 2016. The main actions are in ongoing go-to-market transformation. We are writing some of our non-performing digital assets, and we continue optimizing our production and warehousing capacity. The expected one-offs, 45 million, will be recorded in the next 10 months so that by end of first half 2018, they should be all in. The cash flow impact will be taken in mainly in late first half 2018, and the expected payback is less than 2 years. So that's about P&L structure, what we have there. Moving then to cash flow and asset efficiency targets. The 3 targets what we have set: free cash flow as a net profit, net debt EBITDA, and capital turnover. Let's start first with free cash flow. The target is the annual cash flow conversion of 80%. And here you can see that it has been quite volatile recently, from 50% all the way up to 100%. And that's mainly due to volatility in our working capital. Whilst our net debt EBITDA has been very stable and well below the target 3 times or less. Our capital turnover here reflects the declined top line, as well as the recent acquisitions what we have made, which are not yet delivering accretive asset efficiency. The way we are improving asset efficiency, let's start first with the cash flow there. So again, back to the last 3 years, you can see that we have secured our organic growth so that approximately 50% of our operating cash flow is invested back either in working capital or Capex. And then 75% of our free cash flow is returned back to shareholders in the form of dividend or share buybacks. We have kept our balance sheet solid, so our net debt EBITDA has actually improved, whilst we have still invested some 134 million into acquisitions. Then for the future, for the next 3 years until 2020, we see that our strategy enables us to continue with pretty much similar model. We continue invest in working capital, we continue investing Capex, and leaving enough free cash flow there to continue shareholder cash returns as per our dividend policy. The priorities what we have set for the cash remain unchanged. So on business, the first priority is to secure organic growth, and then secondly, enable criteria-based M&As. On shareholder returns, the first priority is in our dividend policy, i.e. ensure sustainable, steadily increasing dividend, reflecting our earnings potential. And then the share buybacks. These are not in order of priority. Number 1 and number 3 are the first one, and then follows number 2 and number 4. One important part of our cash flow is Capex. And during the past few years, our Capex has increased all the way up to 3.4–3.5% of our sales, which is practically 50% more than our historical level. The main reason there is those investments, development investment, especially in digital. Now when we see that we are gradually getting to end of this kind of platform investment, we are both right-sizing and rebalancing our Capex targets. Let me explain that more in detail. So whilst we are now level of 3.4% there with our Capex, the long-term target is to be level of 3–3.2% of sales. And rebalancing means that we are increasing the focus toward consumer. Practically, it means that this go-to-market part of our Capex allocation gets bigger share. It includes new retail openings, and also refurbishments. It also includes e-commerce, even though e-commerce is pretty Capex light. We continue maintaining our own manufacturing operations and then invest in continuous operation improvement there. So that's another big part of our Capex. And you can see that where we are taking down our Capex is especially towards development. We are right-sizing it, still focusing on digital investment, especially in Suunto, but the total amount is coming down. Then on our asset efficiency, and here on the left you can see our capital employed development from the past 3 years. And out of this 250 million increase what we have had, more than 50% is coming from M&As. And if you take those light blue bars here, which represent organic growth and organic growth related capital employed increase, you can see that we have been pretty efficient with our organic growth, which is the target for the whole organic growth plans. So that organic capital turnover is getting very close to our overall target of 2 times per year. The way we continue driving up our capital efficiency, our asset efficiency there, is mainly focusing on trade working capital. And the target there is to get it down approximately 200 basis points, again, baseline being 2016. Why this is so critical? Our trade working capital is more than 50% of our total capital employed. Right-sized Capex, that's already what I explained. And then when we continue growing at mid-single digit rate, we have, I would say, this kind of natural leverage there for the non-moving assets, i.e. mainly goodwills. They will stay unchanged no matter how much we are driving top line up. So combining profitability improvement, our cash flow target, and asset efficiency improvement actions what we have put in place, we can say that our strategy is addressing all the 3 levers of total shareholder return, so that we are securing profit growth, focusing on margin improvement when the top line is getting more expensive and uncertain. We are focusing on driving our portfolio toward higher margin, better asset efficient, and a faster growth, which is then lowering our risk profile and earnings volatility. And then we are ensuring solid cash flow contribution there by right-sizing our Capex and focusing on trade working capital management. So on top of these organic-related drivers and improvements what we have in place, acquisitions continue being in our toolbox. The criteria we have set for acquisition remain unchanged, so that they are addressing financial impacts, improved profitability, higher asset efficiency in long term. They are addressing leadership position and proven capability, and avoidance of over-complexity for the group. And then the fourth one here is that transaction multiples are limited to company-owned valuation multiples, so that we are not overly stretching our balance sheet and profitability. Based on these criteria, we typically scan some 60 to 80 cases every year, from very small, like 2 million, all the way up to, I would call them mid or even large size, to 300 million. And we have also a solid track record there. We have made 6, and the current net sales value would be 1.1 time the acquisition cost what we have had. Let me walk you through those 6 acquisitions we have made during the past 2 years. We acquired Louisville Slugger for our baseball business. We acquired Sport Tracker to support our Suunto expansion and digital platform. We acquired Queenox for our fitness, Envy for cycling, Evo Shield again for baseball, and then the latest one is Armada for winter sport equipment. If you take 2017 expected sales and overall acquisition performance, you can see that we are actually pretty green there versus the expectations what we had when the acquisitions were made. For example, Louisville Slugger, the savings there have realized as expected. However, top line is now for sure impacted partly this US wholesale situation. Sport Tracker capabilities and platform from Suunto are in place. In Queen's actually, sales growth is exceeding our plans, and therefore we have some growth-related operational constraint there, mainly relating to installations. On Envy, capabilities and know-how leverage in place. We just recently, earlier this year, moved into new factory in Envy, and we are still very much on the startup curve. So all the productivity KPIs are not yet the level they should be when we are at full run. When it comes to EvoShield and Armada, they are all blinking green. To secure our non-organic growth also for the future, we maintain a solid firepower in our balance sheet. Here you can see how much we have potential or capacity for additional leverage under our current balance sheet target of 3 times EBITDA. Just a reminder, the fast-moving consumer good company typically are at investment grade with 2 times net debt EBITDA. We are currently at a level of 2.2. So I have gone through now how we are improving our P&L, gross margin and OpEx, how we are securing our cash flow and solid balance sheet also for future growth, and how we continue driving our M&A. I think now it's time to ask Heikki for summary.
Thank you. Thank you, Jussi. Just a very quick summary. Basically going back to the topics of today, the way I introduced today, we say that we will be prioritizing sustainable, profitable growth, and we continue and will accelerate the transformation. The company logic and drivers remain largely unchanged. Growth continues and will continue. Building blocks are robust and they drive transformation. The external context is challenging and the market is somewhat challenged, especially in the United States, and we are right to make an adjustment to our targets and now prioritize profitability over overly expensive growth. As Jussi has shown, the reprioritized model creates value and the company continues to build financial strength. So that's in a nutshell where we are today and where we're going and how it looks like.